Hey everyone, welcome back to Corporate Decoder, the place where we unravel the mysteries of corporate filings to find the real story behind the numbers. Today we are diving deep into Liquidity Services' incorporated recent proxy statement. Folks, get ready because this one has more numbers than a Las Vegas casino, and we are going to break down what it all means for you. So what is this all about? Well, Liquidity Services Incorporated is calling its annual meeting for 2026, and they sent out a proxy statement to everyone who owns shares. Think of it as an invitation to vote on important company matters and a detailed report card on how things have been going. We are going to sift through the crucial financial highlights and some super interesting compensation details. Let us jump straight into the money matters. Liquidity Services paid its auditors Deloitte and Touch LLP a hefty sum of $1.6 million in fiscal 2025. That is up from about $1.5 million in 2024. This covers their regular audit work and some tax services. Now, while paying auditors is standard practice, it is always worth noting how much it costs to have your books checked. This is not a major red flag, but shows a consistent expenditure towards financial transparency. Now, this is where things get really interesting compensation. Liquidity Services is asking its shareholders to approve an increase in the number of shares they can give out as stock options and other equity awards. They want to add an additional 2.9 million shares to their long-term incentive plan. Why? Because they believe giving employees an executive stock is key to motivating them to perform well and to keep top talent from leaving. As of the 30th of September 2025, they had over 3.8 million options outstanding and still had over 1.3 million shares available for future grants. This proposed increase means they want to have roughly 3 million shares ready to go for future awards. This move aims to keep their compensation competitive and to retain key people. They also mention a share repurchase program, which is a good sign as it shows they are trying to reduce dilution from these equity grants. It is a balancing act managing stock dilution, while also attracting and retaining talent. Let us look at the executive pay. The CEO, William P. Angrick III, had a base salary of $470,000 for 2025. That increased by 2% from the previous year, but his real earnings are heavily weighted towards bonuses and stock awards. His total compensation shot up to over $5.1 million in 2025 from $4.2 million in 2024. This jump is largely driven by stock and option awards and a significant bonus that hit near $2.7 million. His bonus payouts were over 100% of his target. This is a strong indicator that the company performed well and tied a good chunk of his pay to that performance. Looking at the other top executives, their compensation also saw a substantial rise. The average compensation for the other named executive officers or NEOs was over $2 million in 2025. That is a big jump from about $1.6 million in 2024. This increase is also heavily influenced by stock awards and bonuses. The company's pay for performance strategy seems to be in full swing, with a significant portion of these executives' compensation tied to company results. Now, how did the company perform well for fiscal 2025? They reported a net income of about $28 million. This is an increase from $20 million the year before. Their consolidated adjusted EBITDA, which is a measure of operational profitability, was around $60 million for 2025, up from $48 million in 2024. These numbers show a positive trend in both profitability and operational performance. The CEO's compensation aligned with these positive financial results, which is a good sign for shareholders wanting to see performance-linked pay. Now, looking at this whole picture, Liquidity Services seems to be navigating the markets effectively. They are balancing retaining talent with shareholder value by using stock incentives and performance-based bonuses. The proposed increase in stock awards might raise eyebrows for some about dilution, but the company is showing efforts to manage this through share repurchases and a controlled approach to granting options. The company's direction appears to be one of growth and strategic development, with executive compensation clearly tied to achieving those goals. The key risks seem to revolve around market competition and the effective management of their incentive plans to avoid excessive dilution while still being competitive. What are your thoughts on Liquidity Services Incorporated's compensation strategy and their financial performance? Let us know in the comments below. If you found this breakdown helpful, please hit that like button and subscribe for more deep dives into corporate filings. And hey, if you want to chat more about these topics, join our Discord community linked in the description. Thanks for watching, and we will see you next time on Corporate Decoder.